Mid-year review from Ventura Wealth Management. This is Nick Ventura. It is the first week of August. We are enjoying some good markets for a change. It's been about a year and a half of sideways movement. So let's charge right into this and see what we have. People ask us often, what do we believe, would we rate the economy? How would we rate the economy? To really look at this, we're going to say it's a B+ economy. It's not A. It's not growing quick enough to be an A, but it's got pockets of strength, particularly in the consumer-driven sides of the economy, in both housing, in employment, in areas where the consumer finally feels a little bit of relief. So we're going to give it a B+. Unemployment and wages, while wage growth is pretty anemic, the blue line on this chart, the actual unemployment rate is fairly low at 4.7. Now, many argue that that's artificially low because people have dropped out of the workforce, and some of it is true, but it's certainly also true that it is a strong number relative to where we've been in the past few years. Look at CPI. You look at a 50-year average of CPI, it's pretty startling that the 50-year average of the Consumer Price Index was 4.1%. We are, a reading as of May was about 1%. We are the beneficiaries of very affordable energy at the moment. We are not experiencing any shortages, so therefore unemployment is tame. Unemployment, inflation is tame. Corporate fundamentals, we think, are pretty good here. Companies have enjoyed low interest rates, fairly stable activity, but we're going to highlight a couple of things that are turning around as we speak. Over the past year and a half, as I mentioned earlier, this economy has been moving sideways as measured by the stock market. And the reason for that has been a real depression in one particular sector, that being energy. And you can see that on this chart quite quickly. These are the 10 S&P sectors as of right now. And if you look at all of those sectors and you look at the annual average profit margins in each sector, and then you look at the first quarter of 2016, the startling thing is that energy is off the chart. It just fell not only to no profitability, but actually negative profitability. That hampered the entire progress of the entire market. With energy prices floating between $40 to $50 a barrel, actually oil prices floating between $40 and $50 a barrel, there's a stable market. It's not a robust market. It's not a hugely profitable market, but it's a stable market. In a stable market, energy earnings as expressed by the corporate parent should actually recover. So we're hoping for a stabilization, moving to some profitability in the energy sector, which will allow the profitability of other sectors to rise, and as such enjoy a higher stock market. We'll see how it all pans out. If you look at what has actually happened in reported quarterly earnings per share, they peaked in 2014. Interestingly, at the end of 2014, the market also peaked, then proceeded to move sideways, as I said, since then. We are now seeing that recovery. The first quarter of 2016, we saw the first upward trend in quarterly earnings, and we hope to see that again as second quarter earnings complete their cycle. Real estate and commodities are actually an interesting story here. State, as measured by commercial real estate, is doing quite well. We haven't had a lot of commercial construction in this country for years, and the demand for corporate real estate is pretty strong. A couple of trends, actually. Think about baby boomers downsizing. Think about millennials buying their first home. These are trends that are just getting started in the economy now. The baby boomers, as they retire, tend to downsize. The millennials, as they move out of urban centers into more suburban environments, tend to upsize. So as we see that housing trend, and then we think about that's in all of the commercial markets, it's a fairly good underpinning for the real estate market here. There are some sectors of bubble activity. We can think of Manhattan or San Francisco as those types of places. But we're talking about the general trend of real estate throughout the country. Taking a look at residential trends specifically, get back to the average price for an existing home of 2005-06, which is thought of as the bubble top. The difference, though, is that that bubble top back here was created by artificial financing, and you can see the slope of appreciation in 2000s was very steep. I argue that if you took a ruler and started right about here in 1995 and connected it to this dot right here, which is May of 2016, it would be a fairly normal slope, upward sloping trend, reflecting the increase of the value of housing. This bubble activity here, which we saw in the middle of the 2000s, that was really fueled by speculative financing. To prove that point out, if we look at the lending standards for approved mortgage loans, they're actually quite high. It was in the 04 area, you see these lower credit scores in the 600s able to obtain mortgages. Now that is not the case. Mortgage standards have risen substantially, and the buyer is actually more credible. Commodities. I want to say the word China. If China doesn't buy commodities, they decline in value. It is the biggest consumer of commodities in the world, and for many years, we had Chinese consumption driving demand for commodities across the globe. Since China has slowed significantly in its growth rate, commodities themselves have been under some pressure, i.e., emerging markets where most commodities are found have also been under pressure. So this whole decline recently accelerating in 2014 into 16, real slowdown of global activity, accompanied with falling oil prices. If we look at the fact that oil prices bottomed in January of this year at about $26 a barrel, have now recovered to about $4 a barrel, it's not a huge recovery, but something. And because we believe that bottom has been seen and we think there's a stabilization in commodities, it may just be the commodities have bottomed. Global growth, if it picks up just a little bit, could pass on that strength into the commodity market. So beginning ever so carefully to accumulate selected commodities. Gold is a different story. We believe there is a bull trend in gold. Gold bottomed in the end of last year. It has since moved higher. We believe that the rate of interest on a global basis is in demand for gold, meaning that as fewer and fewer countries pay interest, time deposits, in government bonds. Some of these government bonds are actually paying negative rates of return, which is hard to believe. An investor would be smart to question, why will I accept a negative rate of return? Why don't I put my money in gold? At least it's an inflation hedge. And we believe that the old low interest rates that exist globally today drive the demand for gold. We believe gold is probably headed higher. This is the bottoming process that I talked about. It's not pretty. Many producers in this period of time where oil actually plummeted went bankrupt. Some countries are likely to go bankrupt. That is not at all off the radar here. Countries like Venezuela, Nigeria, certain, believe it or not, Middle Eastern countries are threatened with bankruptcy here. So it is a true fact that the shale revolution in the United States has disrupted completely the supply and demand equation for oil specifically, and we have probably seen peak prices in oil for a very, very, very long time. The oil market, the energy market in general, is truly in a restructuring here. we haven't seen the end of the bankruptcies, but we hope that, again, that it's stabilizing. U.S. markets. Here's that sideways motion that I was talking about. So literally peak right at the end of 2014 and go absolutely nowhere. And all during this time, profitability was falling off, not up. It was for the markets to be moving sideways to lower. We had these shocks here. Profitability drives equity prices, period. If you have the profitability, you won't have higher prices. So just now, if we draw a flat line across these tops, we're starting to see a breakout in the S&P 500, which will be followed, of course, by the NASDAQ, small cap index, the Russell, and so forth. But the breakout is significant because all this time the stock market was, if you will, building a base on that lower profitability. As the equity market achieves a higher level of profitability, we could, in fact, get higher prices. Let's take a further look at this. If we measure equity values using traditional measures such as price-earnings ratio, dividend yields, etc., you can see that we're really not overvalued here. We're fairly valued, or we're of an average valuation, perhaps a little bit elevated, but we're certainly not in that scary bubble territory that we were in, say, the late 90s, expressed by this huge spike in valuation here. We're more at a what I can call a consistent valuation. So let's take one more look at this. This chart, that if any chart were to worry us, it's this one. We have been looking at an above trend market for some time now. This is a 30-year chart of the S&P. The red line is the best fit line of entire trend. The green is one standard deviation above or below. The green line is two standard deviations above and below. Well, it's scary when you have markets that are elevated, pushing at higher valuations, and then you say to yourself, well, if that far extended, when do they revert back mean? And then would suggest a move all the way down into, I don't know, 1,800 on the S&P, or a 20% correction from where we are. We're not unconscious about this potential problem, but what I think sort of reticent about is the U.S. stock market is a few profitable markets on the planet. It is one of the better performing economies on the planet. It's a safe haven on the planet. And as a result, we may be in a period of time where we stay above trend for a prolonged period. I won't suggest that we won't eventually revert back to mean. That's always a reality. But we could stay extended for a while. We're in a sort of sweetheart period here. So we'll make the most of it while we're here. Fixed income is really, I don't even know. Anyone who thinks they know what's going on doesn't know what's going on. What I clearly say is that the world is in some type of a deflationary trend. It's in some type of a low demand for a capital. And as such, if you look at organized Europe or developed Europe, these yields in the Eurozone are phenomenally low. I mean, these are crazy yields. A 10-year German bond returns negative 0.1%. I give money to the U.S. government. They hold it for 10 years. They give it back to me for less than I gave them when I started. It seems unreal. In the United States are sitting at 1.5%. Just 6 months ago, sitting at over 2%, about 2.2. So the U.S. market represents one of the few markets in the world where an investor in fixed income can earn a positive rate of return. You could not possibly compare the economic powerhouse of the United States to Italy, yet Italy is borrowing money for less expense than the United States. This is very unreal to us. So as a result, we are believers that the U.S. market is either going to stay right where it is, or yields will continue to decline to match international yields. If the case, Treasury bonds would appreciate even if they pay these very low rates of return. portfolios today, we do have a treasury position as a core position. We're holding it not for that stellar 1.5% return, but rather for the potential appreciation as interest rates continue to fall. This is a telling chart of what I just said about global demand. We are experiencing flows into U.S. Treasuries and U.S. corporate bonds from foreign individual buyers. This is not central banking activity. This is not foreign countries depositing money here. This is private investors buying U.S. Treasuries and corporates. Again, a strong dollar together with some positive rate of return and an appreciating treasury market gives us very strong flows. And if this continues, if the interest rate environment continues as it is today, I see no reason why this will stop. International markets, the big one is Britain. I wrote about this as it happened back in late June. Hopefully you saw that newsletter. It was I tried to hit on all the salient points of Brexit. I believe that this is a negative for Britain. I think it's a long-term negative and a short-term negative. I think Britain will struggle as a non-member of the Eurozone. So let's just take a look at why. The forecast for GDP growth in the UK has dropped significantly. This is adjusted by trade. The next chart is even more dramatic. I'll just move on. The Euro area exports about 7% of its product to Britain, while Britain exports nearly 45% of its finished goods to the Eurozone. I don't know what more to say. They just interrupted their entire trade flow, which represents 45% of their exports, and their export-driven economy. So for all the reasons in the world that they had a nationalistic pride, I suppose, that them to want to break away from the Eurozone is clearly an economic faux pas, and I can't imagine how this quickly rights itself. I think this is a prolonged problem. There will be many trade agreements that need to be struck. There will be a potential conflict within the entities within the UK. Don't forget that just a year ago, the Scots wanted to break off from the UK. I could see a world where the Northern Ireland economy wants to break off from the UK. So the referendums in Europe haven't stopped. They're just getting started. And you're going to hear many more of these potential breakups, which no market likes uncertainty, and all of this causes uncertainty. So I see nothing but trouble ahead in the Eurozone. China is always a topic, and the topic here is really rather quick and easy. There were a lot of fears earlier this year of drastic decline in China's economy. Some of it is true. China has clearly moved away from an economy that can quickly add infrastructure and, if you will, prime their pump. They've built all the roads they need for now. They built all the airports they need for now. Ports, yes. Roads, yes. Bridges, yes. So when they're all built up, you need something else to drive your economy. And they need to drive their economy is the consumer. So we believe that there is a push within the Chinese government for consumer spending, and it's good. They've had a few years now of certainly rising wages, higher, if you will, net worth per family. The Chinese are just learning how to run a consumption-driven economy, very similar. We are a consumption-driven economy. So this transition is something that we have to monitor. And the reason that these numbers on the chart are up here is that when numbers such as services and manufacturing indexes float around 50 or slightly above 50, it's a big positive because it simply means that we're either stable or growing slightly. Both services index and the manufacturing index are very close to 50. So the fear of the big drop from China is a bed for now. So we continue to monitor. We hope the economy there can transition from industrial spending to consumer spending. We'll have to see how that goes. We are bullish on China as a market. There are plenty of other places in the emerging markets to invest money that we like better. But we don't want disruption from China. So we'll continue to keep that on our radar. It shows the drawdown as China defended its currency from 14 into 16. It's a fairly substantial drawdown, meaning the Chinese government itself supported the value of their currency. And then, of course, when we look at monetary policy rates, the Chinese government is clearly trying, through low interest rates, to stimulate their economy. Oh, well, at this topic, to address the concern that we hear as wealth managers. I have no political opinion about this presidential race. It doesn't do any better for us than it does for most of the electorate. What I will tell you is that the bottom chart is the telling chart. We're often asked, what happens if we get a Democratic president and a Republican Congress and a Republican Senate and they're all fading in, and so on and so forth. You down at the bottom of this second chart, number of years where all Democrats have been in charge, Democratic president, Republican houses, Democratic president, Senate, Republican House, and so forth. All of these time periods along the bottom of this chart, there should be something that you see that just jumps out at you. It's really positive. We haven't had a period where there was a Democratic president and Congress with a Republican Senate, so the category in the middle gets a 0. And this period of time with a Republican president, Democratic Senate, and a Republican Congress, is the 2 years of Gerald Ford's inherited presidency. So, all of that turmoil that came in the post-Nixon period, looking at any scenario of Congress, Senate, President, so forth being of different parties doesn't really matter. There's often a way that U.S. corporations manage to make a profit. And if we can just do the same averages that we've done over time, hopefully it won't make that big a difference. All the other noise out there, the U.S. economy tends to be able to survive a different political format. The milestone, I'm wrapping up with this. The Milestone 360 topic, which is our code name for financial planning, this quarter is about life insurance. I will be very specific about how we at Ventura Wealth Management look at life insurance. Life insurance is there as a protection against risk. There are kinds of protection we're most interested in. For our earning, working, income-producing families, life insurance is needed to protect against the possibility that income stream would be interrupted by death. So in a high wage-earning household, we must ensure against the loss of wages if anything were to happen to the primary breadwinners. In retirement, our biggest concern and our biggest risk isn't actually life insurance, it's long-term care insurance. Too many estates destroyed by the effect of the enormous expense of caring for medical expenses that are unexpected after retirement. So rather than maybe this being life insurance, it should be risk insurance or other title. We want to make sure that clients have adequate protection while working and adequate protection of everything they've earned once they're retired. So if you have any life insurance questions, now is the time. It's a quiet time of the year. It's a good time to review these topics. We're past tax season by a long way. We're not into year-end planning, so it's a good time to take a look at insurance and see if there's anything needed. I thank you for your time. It's been a pleasure being with you. If you have any questions, please contact us. Our sources and our contact information are listed on this final page. We appreciate your time this afternoon or this evening, whenever you're listening to us, and do stay in touch. Please call with any questions. Bye for now.